As traders, we all want to get sniper entries like this. But how exactly do you do it? Well, in this class, I'm going to teach you the supply and demand theories that we can use to get these sniper entries, zone refinement, multi-time frame analysis, and how this plays a big role in getting perfect entries on your trades. And all of these things, ultimately, will show you how to get sniper entries. Before we jump into zone refinement, it's important you understand the basics of supply and demand. If you already do, use the chapters to skip ahead. If not, I'm going to explain them to you now. So a demand zone is an area of consolidation before a strong upward move. When we're looking at candlestick charts, it's going to be the candle like this, the candle that sits at the bottom of a large upward move. If we visualize it as a zone, this is what it looks like, okay? It's drawn as a box, and my rule is to use the last candle before the impulse away. So I'm looking for a sideways candle like this with wicks either side and little to no movement, just before a large push upwards. And the idea is that a demand zone shows a price that institutional buying took place previously. So very large players in the market placing very large orders. That's why we get these big drives away, and that's what a demand zone is indicating. The idea here is that this is seen as a discount price to buy from. So future buying is expected if price returns to this level. Here is exactly what we would expect to see from a demand zone. We look to buy from the demand zone when it is retested because we expect to see more of that institutional buying kicking in. Now, if you haven't already guessed, a supply zone is just the same, but the other way round. It's an area of consolidation before a strong downward move, which would be visualized like this. Again, it's drawn as a box, and I use the rule of using the last candle before the impulse to mark my supply zones. This shows a price that institutional selling took place at previously. It's seen as a premium price to sell from, so future selling is expected once the market returns to this level. Here we look to sell from the supply zone when retested, expecting more institutional selling to kick in to the market. It's important to understand the basics of supply and demand because this is how we are going to refine to get sniper entries. If you need further lessons on this, there is a card in the top corner which is going to take you to a pure supply and demand course. You can come back to this video after that, but if you're ready to go ahead with zone refinement and get those sniper entries, we'll do that right now. All right, here's how zone refinement works. Let's say we begin on the 4-hour time frame and we are looking at a supply zone. We want to sell from this area when price returns. The price return might look like this. Our target, nice and simple, just the recent low, means our position may look like this. Now this is a 1.9 risk reward trade, which essentially means you will risk 1% to make 1.9%, you'd risk $1 to make $1.9, and so on. This is okay, but the risk reward isn't great, and it's not exactly a sniper entry. It's not a trade that's going to bring you a massive reward, and if you take trades like this all of the time, yes, you can be profitable, but you're kind of on the edge because the risk reward isn't that great. But what we can actually do then is look inside of the 4-hour time frame. To carry out zone refinement, what we want to do is look inside of the 4-hour time frame. Go lower and identify smaller zones. What we can do here is zoom in to the 1-hour time frame to identify smaller supply zones inside of this 4-hour zone. So here's an example of what the 1-hour time frame might look like. If we were to map on the 4-hour zone, it may look like this because it's going to be covering a broader range of candles. But what we can actually do now is refine this supply zone to a smaller 1-hour zone that exists inside of the 4-hour zone. We see further imbalance and we see a smaller supply sitting at the top. Now what this allows us to do is use this for our positions, okay? So now you can see we've dramatically amplified the risk to reward on this position. If we take it back to the 4-hour time frame, our 4-hour zone refined to the 1-hour zone would look like this, meaning our position would look like this. Same exact trade, same exact target, same selling area, but because we refined, we turned that 1.9 risk reward trade into a 6.25 risk reward trade, which means you're risking 1% to make 6.25%. You're risking $1 to make $6.25 in return. So we're turning the same trades into massively profitable positions just by refining the zones, and we get that beautiful sniper entry. Let's go look at this on a real chart. This is the 4-hour time frame. It's NZD/JPY. It really doesn't matter what asset you're trading. This works across all of them. We're looking at a market which has just shifted in trend direction. So we see a break of structure here, which has taken us from lower lows and lower highs into higher highs and hopefully a higher low for us to take a trade from. All right. So that's the basic trade concept. Now we're going to use the similar technique as previous. Targets wise, we're just going to look at the swing high. So all we're going to be looking for, just like the examples I showed you, is a trade from there to there. Okay. Now, we can go ahead and mark out the last candle before the impulse. That's going to be our demand zone, which in this instance would be plotted on like this, okay? So not bad, pretty nice little demand zone. If we were to map out our long position, we would have an entry there, a stop loss under there, and a target up into that high. Now this is a 3% trade, so it's by no means a bad position. This is something I'd be happy to take. You could get in from here and run it up to here, but we are talking about getting sniper entries. So Let's follow that rule now and go from the 4-hour down to the 1-hour and see if we can find a refined opportunity. Dropping down to the hourly time frame, we see immediately more candles open up. Basically, what we do here when we go from the 4 to the 1 hour is times the amount of candles we get by 4, right? Because we're seeing 4 candles per each individual 4-hour candle. Now, we have two areas. One area of demand here, which is the last candle before this impulse away, and another here, this larger one at the bottom, which is the very low of this market. And this, again, is a last candle before an impulse away. So at this point, we can work out what to do in terms of zone refinement and see what we've got in terms of opportunities to increase the risk reward. For a moment, we're going to remove this one. We're going to focus on this lower one because this is where we can refine our hourly buy limit order to. So from the 4-hour position of 3.08%, if we were to move our entry to the top of this zone without changing anything else about the trade, we are now at 5.58 risk reward, which means in this instance, we've added 2.5% potential to the exact same trade. And all we had to do to get there was drop the time frame from the 4-hour to the 1-hour and refine to this level. Now I want to take it back to the zone just above because the question might be there. How am I going to pick between these two zones? See, sometimes when you go to a lower time frame, you're going to see multiple zones inside of what was once just one zone, and this can make things a little tricky. Now there's a simple way that we can approach this outcome. And before we move on to our new position, we're going to talk about that real quick. So if we now have two zones to choose from, we don't know where to place our order. The simple way to approach this is to place your order on what we call the extreme zone, okay? Now the extreme zone is going to be the furthest zone from price in the leg of price movement. So our leg of price movement is from this low to this high, okay? This is the bullish push. We're basically now looking for a retracement opportunity to then buy from further. Inside of the first leg of price action, which is this one here, the extreme zone is going to be the furthest zone from price, so the lowest possible zone in a buying scenario. That makes this zone the extreme zone. If we want to place a buy limit on either of these zones, the standard one to go for is going to be the extreme. First of all, because we get the best risk reward from this zone, and second of all, because it's just the safest one. If we go ahead and place an order at this zone, for example, and our stop loss is here, we can be right on this position, meaning we could actually be correct about the market direction, but we could still be stopped out if the market decides to reach for the extreme zone. So when it comes to buy limits, the safest way to do this is to just place your order at the extreme zone, which in this instance is going to be that 5.58 risk reward or 5.58% potential return trade. Now, to approach this one, we've got to think the market could react from there. If it does react from there, we're going to miss the trade if we're focused only on the extreme. So what we can do inside of the top zone is use what I call a standard confirmation. This is nothing new. It's just a simple name for a simple approach to structure confirmations in your trading. So a standard confirmation looks just like this, okay? What we would do is when the market reaches this level, we would see if this lower time frame structure changes in agreement with our larger trend direction. So now that we're on the hourly, we can see there's a small trend inside of the larger trend. We have the high, a low, lower high, lower low, then we have a lower high and a lower low. Now at this point, we would basically want to see the market return into this area of demand and then create a new high. If we saw this, let's say it happened immediately from where the market is right now. So if we had a drive down from here, retest of this level, and then a push back above this point, this would confirm that the top zone could indeed be good for a position. Because what it would show us is that this demand zone is seeing an influx of buying that's strong enough to reshape the trend, okay? So if we were able to push over a previous high, it would tell us this zone has more strength than we may have initially anticipated. And that means therefore we could take a buy position if the market was to pull back. So from there, we would identify demand and we would buy from that point to take the trade up towards our target. So once the market reached this point and closed up here, that would be a good time to confirm that you are able to put buy limits on in this area quite safely. So that is how we would approach multiple zones. Now, just to give you an insight into what the standard confirmation looks like in reality, let's just take a look at how we found the premise for this trade. Here we have overall a downtrending market. Then we come down to this low and we got to push up to here. This is that structural shift that we would want to see. So basically we would take this pattern that we've got right here and we would replicate this on a smaller time frame. Okay, so we'd be looking at that. Exact same thing again. If we got that, we could then happily place orders. All right. So that's a visualization of what the standard confirmation looks like in the candlesticks. So that's how you would pick between two zones. Just go with confirmation entries on any top zones, and then the lower zone, the extreme zone, the furthest from price at the bottom of the leg of price action is where your order can be placed. You could place a buy limit there because you'd be quite happy to get in at that point if the market got to it. So if we jump back to the 4-hour time frame now, we can see that we have our top zone for potential confirmations, and we have an order placed at the extreme zone. Now, just removing this one for a moment, we can see that now the 4-hour candle basically has a zone covering half of it. On the 4-hour, first glance, it doesn't really seem to make much sense, but that's because this is a 1-hour zone, okay? That's pretty bad drawing, but you get the idea. So this is our 1-hour extreme zone. The idea here is then that we've actually managed to refine the trade down, and rather than getting in at this high, we're going to be getting in at the extreme, the refined area, which is going to give us the best risk reward for this trade, okay? Now let's see how this market runs out. See, we get pushed down into that extreme zone. And then the market pushes up and makes its new high, which would fill our trade target. And just to show you, if we were working with the 4-hour zone, well, the high of the zone would be there, the low of the zone would be there. So our position would look like this, okay? So we're looking at around a 3% return without refinement, or we're looking at that 5.58% return with refinement, which, as you can see as well, is where we get those sniper entries, because what we've actually done is managed to secure an entry right on the wicks. We're not halfway through the candle bodies, we're not completely above one of the candle bodies as we would be if we'd entered off the 4-hour zone. We've captured the wicks and we've secured a sniper entry. Now, there is one thing you need to be careful of when you are refining zones, and that is over refinement. You need to make sure that you don't refine your zones too far. You could say, if we go from the 4-hour time frame to the 1-hour time frame, and it makes the zone smaller and it makes that entry more refined, why don't we then go from the 4-hour to the 5-minute or the 1-minute? Because surely then we're going to get an even smaller zone inside of this larger zone. Now, the problem with this is, if we go over on the 5-minute time frame and dig into this larger demand zone, we're actually going to find that there are some very small refined zones all the way down here at the low. So we could actually start looking at this demand zone, and we may think, well, this is a nice refined zone. There's still some imbalance into this. So maybe we could place that entry here and our risk reward would be absolutely massive. The problem is the market isn't always going to reach those areas. So although this trade on paper would look good because we'd see potential 25R, meaning we could make 25% for every 1% risked, the problem is a lot of the time it's just simply not going to be hit. We're working off of 4-hour and 1-hour price action here, so dropping the market down this far to the 5-minute is a dangerous game and is often going to result in the trade being missed. Don't over-refine and don't take things too far because you're going to end up with missed positions. Now, a simple rule that's good to follow to make sure you don't over-refine and end up missing out on all your good trades is to go 2 steps down, okay? So 2 steps down simply means if we were on the 4-hour time frame, we could go to the 1-hour time frame, and at best we could go down to the 30-minute. If we were on the daily time frame, we could go to the 4-hour time frame and then maybe to the 1-hour time frame. If we were on the 30-minute time frame, we could go to the 15-minute and then potentially the 5, but we never really want to go too much lower than these, okay? So step down 2 default time frames. 4-hour, 1-hour, 30 is fine. 1 day, 4-hour, 1 hour is fine. 30-minute, 15, 5 is fine. Generally though, you probably only really need to go even 1 step down to secure sniper entries and massively amplify the profit potential of your trades. You saw from this position, we managed to add 2% onto the trade. If you can do a 5% trade, 5.5%, that is all the profit you need for a very healthy month of trading. Taking a trade from 3 to 5.5 and pretty much doubling the returns by simply changing your entry to a slightly lower time frame is definitely very solid, and you don't want to get too greedy and take it too far. Now, while we're here, we can take a look. We're on the 30-minute time frame. If we refined our zone to the 30 instead, we would have had this area to work with. We would have had this area to work with, this candle. I still am a fan of putting stops under the low, so I'd keep that there. But we could have added potentially another little bit of profit there and turn this into a 6% trade by following that 2 steps down, 4-hour, 1 hour, and then 30-minute. So by going from 4-hour to 30-minute, we actually doubled the profit potential of this trade. But if we keep going and we go too far,